Phase 1. The question. Nobody answers honestly. Everyone has an opinion. Your uncle swears by real estate. Your coworker just opened a Robinhood account and will not stop talking about it. The internet has 17 different answers, and all of them are trying to sell you something. Nobody gives you the honest version. The honest version is not which one is better. The honest version is which one is better for a specific person, making specific decisions at a specific moment in their life. Two guys found out. Not by reading about it, by living it. For 10 years, with real money, in the same city, starting from the same place. One chose real estate. One chose the stock market. The results will not tell you what you think they will tell you. Phase 2. The starting line. Phoenix, Arizona. January 2014. You and Ryan. Both 30 years old. Both making $68,000 a year. Both with $40,000 saved. Both have been reading about building wealth for 2 years and have finally decided to stop reading and start doing. You make the same commitment on the same weekend in January. $40,000, everything you have saved, into something that will work while you work. You choose real estate. Ryan chooses the stock market. 10 years later, you will have dinner together, and one of you will order without looking at the menu. Phase 3. The decisions. You buy a house. Phoenix, 2014, 3-bedroom, 2-bath, $210,000. You put $40,000 down. Finance the remaining $170,000 at 4.1% over 30 years. Monthly mortgage, $820. You rent it immediately, $1,350 per month. Cash flow, $1,350 rent, minus $820 mortgage, minus $180 insurance, and taxes minus $100 maintenance average. Net, $250 per month. $3,000 a year, you celebrate. This feels like winning. What you do not fully calculate yet is the $170,000 of debt sitting underneath the $250. But the asset is real. You can drive past it. You can touch the walls. You can point to it and say, I own that. That feeling matters to you, more than you initially admit. Ryan opens a brokerage account. He transfers $40,000 into a total market index fund. Expense ratio, 0.03%. Automatic dividend reinvestment, on. Automatic monthly contribution, $400. He does not celebrate. There is nothing to celebrate. A number on a screen does not feel like anything the way a house feels like something. He sets it to automatic and tries not to think about it. Trying not to think about it turns out to be the most important financial skill he will ever develop. Phase 4. The reality. Year 1. Your house is generating $250 a month. You feel like a real estate investor. You use that phrase at parties. Then the water heater breaks. $900. Then a tenant calls at 11 p.m. because the garbage disposal stopped working. $180 for the plumber. Then the tenant moves out after 11 months because they bought their own house. You spend 6 weeks finding a new tenant. 6 weeks of no rent. $1,350 times 1.5 months, $2,025 in lost income, plus $400 to repaint 2 rooms, plus $200 to replace the carpet in the master bedroom. Year 1 net, $3,000 from rent, minus $1,280 in repairs, minus $2,025 in vacancy, minus $600 in miscellaneous costs. Actual net, negative $905. You do not tell people this at parties. Ryan's portfolio, $47,200. He has not touched it. He has not checked it more than twice. He has added $400 every month because that is what he set it to, and he did not change it. The market returned 13.4% in 2014. Ryan did not earn that return by being smart. He earned it by doing nothing. Doing nothing is harder than it sounds when the number goes down and you have to sit with it. But in 2014, the number went up. Ryan went to sleep, $7,200 richer than when he started. He did not have a water heater story. He did not have a tenant story. He did not have a 11 p.m. phone call story. He had a number on a screen and $400 less per month in his checking account. Year 3. Your property has appreciated. Phoenix Real Estate is moving. The house you bought for $210,000 is now worth $247,000. On paper, you are worth $37,000 more than when you started. You have also collected approximately $6,800 in net cash flow over 3 years after accounting for vacancies and repairs. Total gain, approximately $43,800 on your $40,000 investment. This is a strong return. You are right to feel good about it. Ryan's portfolio, $71,400. He has contributed $400 every month for 36 months. $14,400 in additional capital. His original $40,000 plus $14,400 in contributions would be $54,400 at zero growth. His actual portfolio, $71,400. Market gains, approximately $17,000 on top of contributions. He is also contributing. You are not. Your cash flow is going toward a new roof estimate you received last month that came in at $8,400. The roof is not optional. The roof is in year 4. The $8,400 is coming whether you are ready for it or not. Year 5. The roof happens. $8,400. You have it. You saved it from the cash flow over the previous 18 months, specifically because you knew it was coming. You also increased the rent to $1,650 per month. Phoenix market is moving. You have a quality tenant who has been there 2 years, and you do not want to lose them. They accept the increase. Monthly net cash flow, $450. Annual, $5,400. The house is worth $290,000. Your equity, $290,000 minus the remaining loan balance of $148,000, $142,000, from a $40,000 down payment. You are sitting on $142,000 in equity plus $5,400 per year in cash flow. This is working. You start thinking about property too. Ryan's portfolio, $118,000. He has not thought about property too. He has not thought about anything. He increased his contribution from $400 to $600 per month when he got a raise in year 3. He set it to automatic and did not think about it again. His total contributions over 5 years, $40,000 original, plus approximately $27,000 in monthly additions, $67,000 invested, $118,000 in the account, $51,000 in returns he generated by doing almost nothing. Phase 5. The leverage conversation. Year 6. You buy property 2. You do a cash-out refinance on property 1. Phoenix values have risen. The house is worth $310,000. You pull $60,000 in equity out at 5.8% interest. You use it as a down payment on a second property. $285,000 purchase price. $60,000 down. $225,000 financed at 6.1%. Monthly mortgage, $1,364. Current rent in that Phoenix submarket, $1,900. Net cash flow on property 2, $1,900 minus $1,364 minus $220 in taxes and insurance, minus $100 in maintenance average. Net, $216 per month. 2 properties, total net cash flow, approximately $666 per month. $7,992 per year. You are a real estate investor now, not a phrase at parties, an actual one. You also have $310,000 in property. 1 value plus $285,000 in property, 2 value minus $148,000 remaining on loan, 1 minus $225,000 on loan, 2 minus the $60,000 refinance you pulled out. Net equity, approximately $172,000. You have 2 assets, you have 2 loans, you have 2 tenants, you have 2 properties that can each call you at 11 p.m. Ryan has 1 account, He has not done a cash-out refinance. He has not called a property manager. He has not driven past anything to feel the reality of his investment. His portfolio, $168,000. He is thinking about increasing his contribution again. He calls you to ask if real estate might be better. You say, "It depends." You mean it. Phase 6, Year 10, January 2024. 10 years. You and Ryan have dinner in Scottsdale. Nice restaurant. You both order without looking at the menu. Your real estate portfolio, Property 1, worth $390,000. Loan balance, $131,000. Equity, $259,000. Property 2, worth $355,000. Loan balance, $208,000. Equity, $147,000. Total equity, $406,000. Monthly cash flow from both properties, approximately $820 net after all expenses. Annual cash flow, $9,840. Total 10-year return, $406,000 in equity, plus approximately $52,000 in cumulative net cash flow, minus the $60,000 you pulled out in the refinance, which is accounted for in the loan balance. Net position, approximately $458,000 on an original $40,000 investment. You also spent approximately $34,000 in repairs, vacancies, and capital expenditures over 10 years. True net, approximately $424,000. This is exceptional on paper. Ryan's portfolio, 1 brokerage account, no properties, no tenants, no repairs, no 11 p.m. calls. Total contributed over 10 years, $40,000 original, plus $72,000 in monthly contributions, over 120 months at an average of $600. $112,000 total invested. Portfolio value, $371,000. The S&P 500 returned approximately 12.8% annually over this specific 10-year period. Ryan did not beat the market. Ryan was the market. $371,000. Completely liquid. No debt attached to it. No tenants inside it. No roof that needs replacing in 2 years. You look at each other across the dinner table. You have $424,000 in net real estate position. Ryan has $371,000 in a brokerage account. You are ahead by $53,000 over 10 years, with significantly more work, with significantly more stress, with 2 loans that exist in your name and will exist in your name for another 20 years. Phase 7, the uncomfortable truth. Here is what nobody puts in the real estate versus stock market debate. You won, on the numbers. Slightly. You also worked for it. Not dramatically. Not every day. But the 11 p.m. calls were real. The roof was real. The 6 weeks of vacancy were real. The property manager you eventually hired at 8% of gross rent was real. Real estate gave you leverage. Leverage gave you the edge. A $40,000 down payment controlled a $210,000 asset. When that asset appreciated, you benefited on the full value, not just your down payment. That is why real estate builds wealth. Not rent. Not cash flow. Leverage on appreciating assets. If Phoenix had not appreciated, if you had bought in a flat market, Ryan wins. Not slightly. Decisively. Ryan's number is fully liquid. Tomorrow morning, Ryan could sell everything in 4 minutes with no transaction costs. No real estate agent. No closing costs. No capital gains, complexity on a leveraged asset. Your $424,000 would take 60 to 90 days to access. Would cost you 5 to 6% in agent fees. Would trigger depreciation recapture taxes you have not fully modeled yet. The true comparison is not $424,000 versus $371,000. The true comparison is what each position costs you to access and what it costs you to hold. Real estate won this decade in this city with this appreciation. In a different city in a flat market with difficult tenants, Ryan wins by a significant margin. The stock market won every decade that real estate went sideways. The stock market won for every person who did not have the temperament for a 11 p.m. phone call about a garbage disposal on a Tuesday in November. The question was never, which one is better? The question was always, which one will you actually do consistently for 10 years without quitting when it gets uncomfortable? Ryan did not quit when the market dropped 34% in March 2020. He added $600 that month, same as every other month. He did not check the account for 3 weeks. You did not quit when the roof came in at $8,400, and the tenant before that had left the master bedroom in a condition you do not want to describe. You both stayed. That is the actual answer. Not real estate, not stocks. Staying. Staying is the only strategy that has ever worked for anyone who was not already wealthy when they started. The asset class is almost irrelevant compared to the decade of staying that made either one of you worth sitting across from at a dinner where neither of you looks at the menu anymore.